Everybody, thank you for joining us for today's webinar, the 2013 CAISO Summer Outlook. We're going to go ahead and get started now.
Great, thanks. My name is Chris Jilka. I'm the head of the West Desk at Genscape, and I'm joined here by Chris DaCosta, who's our lead CAISO analyst. So today we're going to talk about our summer outlook for the California Independent System Operator. I'll start the discussion by recapping summer 2012. We'll go over some regulatory changes. Then I'll turn it over to Chris, and he'll talk about weather and demand, and then get into some of the fundamentals that we expect to occur this summer, and then we'll sum it up for you. During the webinar, if you have any questions, you can just type them into the box at the lower right-hand part of your screen. So we'll start off with a price history or a heat rate history of MRTU. So what you're looking at here is 4.5 years of the MRTU market since inception. The top blue dotted line is the marginal congestion component of SP15. The red line is the day-ahead SP15 heat rate. The black line behind it is the real-time SP15 heat rate. So what you'll notice right away for the first couple of years of MRTU, there was not much congestion in the day-ahead market. Starting in the beginning of 2011, they initiated convergence bidding, so you started to see more congestion. But really when you saw the biggest change was the beginning of 2012, when one songs unit went out in January and the second one went out in February. And immediately that exposed a layer of congestion we hadn't seen since MRTU began. You can also see that it was a pretty hot summer. You can see the two heat waves there. You had very high heat rates. It set records as far as the day-ahead heat rate in SP15. And then also the day-ahead real-time heat rate spreads blew out. It's a little bit hard to see, but the black line goes up, beyond the dashed blue line. A lot of day-ahead real-time volatility. And then moving forward to 2013, that marginal congestion component of SP15 kept being volatile. We've seen volatility all the way from January up till even the present time. So we're in May in a fairly low demand period, heading into the highest demand period of the summer. So those two heat waves that I pointed out in the prior chart, your peak day was August 13th, and that hit a peak of 46.8 gigs. Demand was 500 megawatts above the 1- and 2-year forecast, which is probability of 1 day in 2 years. The heat rate for day ahead was around 20, and for real time it was around 43. The CAISO enacted demand response of 1.2 gigs that day, and they committed, more importantly, 800 megawatts of minimum online capacity in the day-ahead market, which has a dampening effect on your day-ahead SP prices. Convergence bidding net revenues spiked over $33 million, and this was the highest revenues paid to virtual bidding entities since virtual bidding began. And it was caused by some of that real-time volatility that I talked about previously, and obviously the day-ahead and the real-time prices diverging. Another thing that we witnessed last summer was the frequency of price corrections. And this plot here, the bar chart, the light blue bars are price corrections for data input, which is expected, really. We do see a certain amount of those throughout the year. You saw a lot of them during the summer. But what we have seen since Q3 of last year is a lot more software-induced price corrections. And we saw those at the beginning of this year with the introduction of a new control area, and through March and April. And we've actually seen, we think, talking to our clients, reduced ICE liquidity because of the frequency of these price corrections. So to switch into congestion, I'll just go over some of the main constraints that we witnessed last year. The big one was SCE PCT. which occurred in 24% of all the hours of Q3. It has a positive effect for SCE, negative effect for PG&E, and if songs is not in, you will most likely see it again this summer, and Chris is going to talk about songs later on in the presentation. TM bank flow occurred in 23% of all hours. That has a reciprocal effect. It's positive PG&E, negative San Diego. And last year, NP15 cleared over SP15 to 3 or 4 days, which is very unusual. It disconnected the Feather River hydro system, which is 600 or 700 megawatts from the rest of the system, and also loop flow causes that congestion as well. The last one is Sycamore Canyon, Carlton Hills, which we saw 23% of all hours, which has a positive effect on San Diego. Now we're going to talk about real-time congestion. We saw a lot of the same nomograms bind in real time with less frequency but a higher magnitude. And the two ones that I want to talk about are Bar Lewis, 1.7% of all hours, very high effect in San Diego. And then Hoodoo Wash, North Gila, which also has a very high effect on the San Diego DLAP, and that protects it for a voltage loss on the Hassayampa North Gila line. Real-time congestion offset charges spiked in Q3 of last year, and that actually provoked a tariff amendment. So what are those? They are the difference between congestion payments that are paid to generators and what is collected from demand and is charged to demand as uplift. So what happened was in Q3 of 2012, most of it was caused because of reductions in transfer capacity as you went from day ahead to real time. And why were there more constraints in Q3? There's a lot more wildfires, and of course you had the SONGS outage, and then you have the ever-present problem of loop flows from adjacent control areas. So what is the ISO doing about it? They filed to FERC to reduce the price of the transmission relaxation parameter, which acts as a strike to clear the market. And that's going to go from $5,000 down to $1,500 per megawatt hour. You know, constraints are managed by redispatching units with the highest effectiveness factors first. So when the cost of the next 1 megawatt reduction reaches this parameter value, the software will relax the transmission limit. So to put that in context, that 1,500 number with other ISOs, ERCOT's currently 5,000, MISO is 3,000, New York is 4,000, and the data is not available for PJM in New England, but you can see the CAISO is now under all the other ISOs. The other thing they're doing, which started at the end of last summer, is compensating injections, which are automatic injections, withdrawals, external CAISO points based on actual real-time flows. The transmission relaxation parameter was effective a couple weeks ago, and that's the very first part of a real-time market redesign, which will include FERC Order 764, which is 15-minute scheduling, and then eventually, someday, the re-implementation of virtual bidding at the interties. And we think this real-time market design, the effect will be a decrease in your dark spreads. Another big obvious regulatory change was cap and trade. You know, carbon market was implemented January 1st of last year, which basically forces the states to return to 1990 greenhouse gas levels, which should deliver an approximate 15% reduction in greenhouse gas levels compared to not doing anything. And just to do a quick example of the impact of it, if we talk about the marginal energy component, we've seen the price for carbon vary from 14 to 1660 per metric ton in the last 4 months. If you take a 1570 value, that equates to about an 835 megawatt hour cost increase on a 10 heat rate natural gas unit. And it also increased the marginal congestion component as well, because as you redispatch the less efficient units, which are some of the older CTs in the system, it creates higher shadow pricing than you would have had prior to carbon. This is another way to look at the demand recap from last year. So looking at this plot here, on the left axis, you have summer demand as a percent of your annual demand, and then the energy on your right. So you can see the yellow line diverge from the green line, just showing to you what an anomalously hot summer it was last year, in reference to the ones before. Then to recap the last 5 years of peaks, the takeaway from this slide is in general, PG&E system peaks before SC&E. Sometimes SC&E can even peak towards the end of September or October. And then we have a team of 3 meteorologists, and we asked, does it have any correlation to the ENSO state? And right now we're in a neutral ENSO state. So you can see it's sort of all over the place. There's no real definitive trend between ENSO and the time of peak demand, at least not in the 5 years we're looking at here. So now to look forward to summer, I'm going to turn it over to my colleague, Chris.
Good afternoon, everybody. Taking a look at NOAA's change in temperature outlook from April 16th to the most recent update of May 16th, looks like the area with the greatest likelihood of above normal temperatures has decreased, whereas in the prior forecast it was centered primarily around the Four Corners area. It has since decreased and moved more toward the New Mexico and Colorado states. And just based upon previous years, it looks like the progression of warmth through the summer, the best likelihood of above normal temperatures remains toward the latter half of the summer in California. Now, moving on to the most recent NOAA Precip Outlook, it looks like the area of expected below normals has increased from the Idaho and eastern Washington areas to encompass a greater portion all the way to the coast of both Washington and Oregon, and even into part of Northern California. And this is slightly different from what we're forecasting here on the next slide. If you look at the chart on the right, or the map on the right, we're actually anticipating above normal precip for the northern Pacific Northwest area, pretty much the entire Washington and most of the states of Oregon. This is primarily going to occur in June with below normal precip expected throughout all of California, whereas NOAA was actually expecting normal levels of precip. Now comparing our temp outlooks to the NOAA outlook, it looks like we're most similar to the most recent temperature outlook. Now in Southern California, we see slightly below normal temperatures at the coast, moderating to normal as we progress through the summer, and we see slightly below normal temperatures as we move inland from last year. Looking at Northern California, it's a bit different. We're seeing slightly below normal temperatures to start June, but higher water temperatures year on year, combined with the much drier forecasts, create a positive feedback loop as summer progresses. And this should lead to more frequent and sustained heating events, particularly in the Bay Area, which has trouble getting into the 90s. Now, speaking more toward the decreased precip year on year, we're actually now drier at this date last year, as the entire state is really seeing some levels of drought, whereas before it was primarily located in Southern California. And it's actually been intensifying as we move on in the year. Last month, it was only a portion of the state, but we're continuing to see very strong drought levels as we roll forward, and we've actually seen already a couple of forest fires as a result. Speaking of which, if you look at the chart on the left, pretty much the entire state of California has a severe risk of wildfire potential, and that includes and it's actually surprising to see Oregon and Idaho see those levels as well. The one strip of California which does stick out is the San Joaquin River Valley, which, for the simple fact that there's a river running through it, that risk is a lot lower than you would see for the rest of the state. But on top of that, the chart at the right goes to show how far we are from normal as far as the California snow water equivalent is. The snowpack in the entire state is less than 5% of normal, which is a staggering number to think about. Now, as we move through the year, the Santa Ana winds typically seen in late August, early September would amplify fire risks, and that is actually also some of the highest load levels of the year, as we've seen on the prior slides. Speaking of California generation, if you look at the chart at the top, it looks like in Q3 of last year, the summer months, hydro was about 8% of total generation. Now, to put that in context, we're looking at much lower levels this year. If you look at the chart on the bottom left, it actually looks like we're seeing a healthier hydro situation than last year, but that's actually somewhat deceptive. We've actually seen some early runoff this year, which will just lead to larger deficits as the year moves on. Now, the situation is entirely different in the Northwest. We've actually increased the amount of hydro expected in the past 3 weeks. So we are in a relatively normal state, about 97% of normal for this time of year at the Dells. But we're significantly lower than the previous 2 years where hydro levels were anomalously high. So you have to look back to, it looks like, at least 2010 to get a similar hydro situation in the Northwest is what we're seeing right now. And the chart at the top left shows the very high and not surprising correlation that you see between flows along Packy and Knob for depending on how healthy the hydro situation is. And so this year it looks like we're going to return to normal. But that does mean as we move through the year, we're going to see, again, lower imports as we move towards September, right when it looks like load is expected to hit some of the highest levels in the state. Now moving on to wind generation. Looking at the top left chart, you see the capacity factors on an hourly basis for the months of June, July, August, and September. Now, June does have the highest capacity factor of wind of any other month. It's around 40%. And that's important because looking at this year, we're seeing record levels of wind. We hit about just under 4.1 gigs a little over a month and a half ago, which is the new record. And it looks like there's about just under 5.9 megawatts of installed capacity in California. So we do expect to see, again, high levels of wind in June, but then again decreasing as we move toward the end of the year. Now moving on to congestion, here we have about 4 or 5 constraints which are very prevalent during the summer months, particularly in Southern California. Now we've already talked a bit about SEEPCT, but looking at south of Lugo, it is very highly correlated to high levels of load, particularly in the LA Basin area, along with outages seen at Mira Loma and Rancho Vista. But we do show a couple of units on Genscape that help to relieve the constraint, particularly at Owanda, which has one of the highest effectiveness factors at reducing that constraint. And just to give you a little context, a couple of days ago, I believe a week or so, we saw the appearance of this congestion for the first time this year as a result of high load, where I believe we hit about 3.6 or 36 gigs, sorry. And so we're looking at more of that for the summer as long as those outages are occurring. Now, moving on and continuing with congestion, this map here shows a graphic about the wildfire potential overlaid on top of the southern transmission system. And if you look at the area with the red box around it, that's the San Diego area. And that is the highest level of concern, particularly with the potential loss of SWIPL or the Sunrise Power Link. There is currently limited generation in that area with the loss of songs, and we did see some very high levels of congestion last year in the summer, if you recall back to a couple of the first slides. And so the loss of one of these lines, which do lie in very high-risk areas for wildfire, could spell disaster for San Diego, similar to what we saw a couple of years ago with the the blackout in San Diego. Speaking of songs, SCE did file an amendment to attempt to restart Unit 2 at 70% capacity by June 1st. It is looking very unlikely like that's going to happen. I believe the most recent date where this can occur is the middle of June, June 10th or June 13th. Essentially, they plan to try to run the unit at 70% capacity, which would be very helpful for the aforementioned San Diego area, as well as providing voltage support to enable the increased transfer capacity into particularly San Diego, but also SCE. Now, some of the risks as we move toward through the summer, if there is no word from the NRC, is a potential for a permanent shutdown of both Units 2 and 3. And I believe we'll know more as we move into June. But as every day goes by, it's looking like that's more likely. Now, one of the things that makes this summer a little better than last year with the loss of songs is that we have seen an incredible build-out in solar generation. It looks like we're up about 100% year-on-year into 2013. And if you just take a look at the map on the left, that shows some of the projects that are currently operating, which are the green projects. And yellow shows the current build, so we're looking at even greater capacity in the near future, with the blue projects in the planning stages. Now, looking at the capacity factor at the top right, I don't know if you guys recall back to the wind capacity factor in the summer, but it's a very, they look like they benefit each other very well. Particularly in the early months when June is going to be a very high diurnal shape. It looks like the increased solar capacity when the daylight is going to be longest would fit very neatly into that. Now this next page just shows an overlay of output with wind and solar at a monthly level from 2012. Looking at June, it looks like it matches each other very well with the solar output filling in some of the troughs of the wind due to the diurnal shape. But we do still see some risks during the morning ramp before solar has a chance to increase output and wind is on the downward slope. But one of the major takeaways, I think, from these four charts is just how big of a decrease there is on output as we move through summer from June to September. It looks like there's about a 56% decrease as we hit September in wind output, and there's really no capability of solar actually making up the difference. And actually the shape, I think, decreases for solar as a result of as we move towards shorter days. Looking at the solar generation outlook for this summer, it is also a lot healthier than what we saw last year. There are actually three large plants that have come online, two of which are peakers that came online early, Walnut Creek, Marsh Landing, and Sentinel. And Sentinel is of particular concern. It's located directly next to the Devers substation in SCE, and it is meant to provide backup power for intermittent resources that have been built out. And Walnut Creek is also of concern just due to the location in the LA Basin area. So we are looking at a much healthier thermal stack than last year, even when you take into consideration the fact that Huntington Beach units 3 and 4 are no longer operating. They're providing voltage support in the San Diego area. But this added capacity, it goes a long way to improving the outlook, and it's actually scheduled to get better as Los Esoteros, Russell City, and El Segundo redevelopment come online as we move through summer. And this just shows how much generation capacity we have installed in the state from 2012 to current 2013, and then what's planned to come on in Q3 and Q4. Q2, the most recent quarter, has by far the largest increase in natural gas resources, and that includes some of the aforementioned units like Sentinel and Walnut Creek from the previous slide. But we're also seeing a lot more solar coming online, which should help the situation in the southern portion of the state, but also overall as far as added capacity is concerned. Now, in summation, the market in the summer of 2012 saw some brief but extreme heat events, and the lack of songs resulted in a lot of unanticipated congestion. And there have been some market changes to address these issues that are currently in place. Now, looking forward, we do have a lower confidence in that heat seen last summer, particularly in the southern portion of the state. It's a little different in the north. But looking at some of the biggest risks, those are forest fires as a result of just the continued drought we're seeing in California. They could potentially wreak havoc with some of the loss of the major interties. As we've added generation, a lot of that has been in the eastern portion of the state, away from some of the major load zones. But that added generation does help deal with the loss of songs that we are anticipating to last through this summer. So if you guys have any questions, feel free to type them into the box at the right-hand side of your screen.
All right, looks like we got a couple questions coming in. Let's see, the first one says, do you think we will see the same level of SCE PCT congestion as we did last summer? I think I'll let Chris handle that. He's the one in the markets on a daily basis.
I do think we continue to see that congestion. I don't believe it'll be as frequent with the addition of a lot of wind capacity, particularly in June and part of July. But when we do see it, it will be to a much higher level as a result of just the CO2 adder that the less efficient units in the southern portion of the state are going to be having to pay.
Great. So there's a couple more. Do you think the 1 gig hydro D rate in the CAISO's 2013 summer supply assessment is accurate? Yeah, we talked about California Hydro throughout the presentation, so I think the answer is probably no. I think when that assessment was done, that was at the end of April, and the snow water equivalent was probably in the high teens, and it's, as Chris said, it's in the around 5% now. And then also, Chris and I took a look at the monitor on our Big Creek unit, and I think he might have mentioned it that it's probably at the lowest levels in May that we've seen for going on 5 or 6 years. Let's see, another one is how much demand response does the CAISO have? I think offhand it's around 2 gigs, and I think it's split up roughly half for price response and half for reliability. And the ones that kicked in on the heat wave of last year were, I believe, reliability based. Let's see. Do you think reconfiguring the Bar Ellis 230 kV line from 2 to 4 circuits will reduce San Diego-based congestion? I think I'll let Chris handle that one.
I do think it will relieve some of the San Diego congestion that we've seen. It wouldn't really have had an impact in, I think, the Hoodoo Wash, North Gila congestion that we saw. But I think as far as some of the San Diego import limit congestion that we can see from time to time as a result of reduced generation, I think that this will take care of it, at least somewhat.
Great. I think that's about it for questions. Yeah, so I wanted to thank everybody for attending, and I want to remind you there'll be a brief survey. If you could please take that before you exit the webinar. Thanks a lot.